Hello, hello. Welcome to this session. So, this is week 5, and we are talking about entry models, execution, and risk management. I believe you have gone through from week 1, week 2, week 3, week 4. If you've not, kindly go and do that because at the entry model, you don't know what you're talking about if you haven't gone through the first 4 videos of the course and you've done the assignments. Now, a setup without an entry model is a wish. A risk plan without execution is theory. This is the world of trading, and I am Trader Mzambezi. So let's continue. Let me just do something small and get back. Now, when we talk about risk management, what comes into your mind? What comes into your mind when you talk about risk management? What comes into your mind? Risk management basically is what keeps you in the game. Risk management is what ensures you survive in the game. Just a moment. As I fix something here, then we continue. Welcome back. Entry models, execution, and risk management. A setup without an entry model is a wish. A risk plan without execution is theory. This is the war room, and this is the smart liquidity concept. Now, when we talk about entry models, execution, and risk management, what comes into your mind? Risk management is what keeps you in the game. Risk management is what ensures you survive. And once you survive in this game, you're bound to thrive. Let's roll. So, in this week 5, our primary objective is to ensure that you as a student, you are to execute trades using the defined SLC entry models with precise risk management, demonstrating mechanical consistency in a demo environment first before you go and shift to real environment. In the real environment, this is where now you chew the meat. This is where now you crush the bones. This is where now you deal with the emotions. But at this point, you have to have first built a consistent and mechanical risk management. Number one, execution precision. That is the core theme, the bridge between analysis and outcome. Usually, if you've ever backtested, if you've ever backtested, you understand that your backtesting results usually go to the roof. They have an exponential curve. While if you've ever tried a real money, real trading, you find that there is a gap. This gap is what is known as discrepancy. Discrepancy. Now, if you can reduce this gap between how you perform on a real account and how you perform on a demo environment or on a backtesting site, that is where now The bridge between analysis and outcome is reduced. Our psychological focus is dealing with the situation, fear of entry, post entry anxiety, and making execution mechanical. Now, if you can learn how to deal with the station during entry or fear of entry because you fear losing money, or once you've entered, you start feeling anxious that your money is at risk. That is our psychological focus. And the only way to deal with it is making execution mechanical. Now, let's roll. This is just an introduction. We have different types of entry models. We have entry model 1, which is the order block retest entry model. The order block retest entry model. This is the most conservative smart liquidity concept entry with the highest probability of working because it has the clearest rules. We basically wait for price. Price conducts a liquidity raid. So number one, we've talked about liquidity raid. If you don't know about liquidity, go back to the last lesson. You wait for a liquidity raid. You wait for a liquidity to raid. Okay. After a liquidity raid, return then it returns to the valid order block. Then in the lower time frame, it shows you a bullish or bearish break of structure, confirming institutional engagement. This is best for students who are building confidence and traders in uncertain market conditions. So I'm going to show it. Number one, setup requirement. Liquidity has been raided. Buy side liquidity or sell side liquidity has been swept. These are we talked about liquidity cycle, AMD, accumulation, manipulation, and distribution. So if you see price ranging, building up liquidity, next thing, wait for something like this. Wait for a liquidity raid. Liquidity raid is where price sharply drops, collecting liquidities that were resting either below, by either sell side that were resting below this point. Price is now returning to one unmitigated order block. Then it returns back to this order block. But remember, even at this point, there are still some liquidities that were resting at this point. Then first candle close that breaks the most recent lower time frame swing in the direction of the higher time frame bias. Now, if it comes and breaks, remember, let's say that our daily time frame or our higher time frame, 1 hour, whatever the higher time frame you're using, is bullish. We are trading, we are planning to buy. So it comes back, takes out all those sellers who are buying at this point, then gives us an break, collecting also these other liquidities. Okay. It breaks this structure. Okay. First candle close that breaks the most recent lower time frame swing in the direction of the higher time frame buyers within the order block zone. Then below the lowest wick. Now, this one will be our break of structure. Let me show it. Where is it? Let me show it. Entry model 1. This point is our order block. Okay. First, you've had this raid at this point. It has taken out liquidity. So number one is liquidity raid. Number two, wait for a break of structure. Okay. Which also takes out these other liquidities. Then wait for price to pull back to the order block and returning to the unmitigated order block. Okay. Then within the order block, this is now where your entry is, and you look to buy, targeting the higher time frame using the risk management that I'm going to show you, and your stop loss below these zones. Now this one is for buy. sell is resting here. Okay. So number one, wait for a liquidity rate. Number two, wait for a break of structure. Number three, wait for price to come and mitigate the order block. Then enter. Okay. This is one of the most profitable entry models. Below the lowest wick. Now there is a way you can be aggressive. This is a real arbos. This one is an arbos. Okay. Real break because it has already swept and it has come and also swept. These are the guys. Pull back to the order block that caused the sweep. This one is basically what I call inducement POI, inducement point of interest. Then now you continue. Stop loss placement below this point, the lowest wick of the order block, or above the highest wick if it's in a bearish situation. If price reaches there, the order block is mitigated. The next buy side liquidity or sell side liquidity on the 1 hour or 4 hours. Minimum 1 to 2 RR. Now entry is at this point. Then target above there. That is entry model 1. Entry model 2 is where now you wait for a fair value gap fill. After an impulsive move, price retraces into an unmitigated fair value gap. Entry is taken when price enters the gap and shows a rejection candle on the lower time frame break of structure within the gap. A more aggressive than order block retest, best used when high time frame buyers. It's very strong and clear. So let me explain this on how this one goes. Setup requirement. We need to have a clear, strong, impulsive move that created a visible fair value gap on 1 hour or 15 minutes. Let's go to 15 minutes. Price has moved back, has pulled back to the fair value gap. Now, if you see an impulsive move, okay, to the upside that left a fair value gap. This one is the 15 minutes time frame. Then now price is pulling back. Price is pulling back. Okay? And it has come back to fill the fair value gap. Let's say this one was our fair value gap at this point. Right here. This one was our gap. Once price comes back and fills the gap, okay, then you see a rejection candle. Rejection candle. Basically, after filling the gap, a strong impulsive candle to the upside. The rejection candle, which is a quick wick that closes outside the fair value gap, or you see a lower time frame break of structure, okay, within the fair value gap in the direction of the high time frame bias. You enter. You wait for after the rejection candle. You wait for a pullback. Then you enter. Okay. Where is it now? Stop loss. We say you place at the bottom. So your stop loss can be below this point, at the bottom of the fair value gap if it's a bullish, or above the fair value gap if it's a bearish. Okay, meaning that price can still come back deeper into the fair value gap. So you allow the breathing room. Okay, so these ones are just you only trade the filter. So entries at this point, once you see this break, pulled back, enter, entry, a sell. Then now you're looking to target a higher time frame liquidity. If it is external range liquidity or 1 hour liquidity, external range liquidity. Okay, that is one way you can look to benefit. So now this one is entry model 2. Okay, let's get to entry model 3. Liquidity sweep. The sniper. The sniper. The highest conviction, highest RR entry in smart liquidity arsenal, reversed for most obvious, most predictable setup. Price sweeps unknown liquidity levels, create a sharp wick, and immediately reverses, creating a church on the entry time frame. Stops is tight, target the opposing liquidity. So the setup is like this. Price sweeps are crystal clear. Let's say we had something like this. Okay, we had something like this. Right here we have something like a support area. Liquidity is resting below here. Okay, Now, price does this. Price comes back, sweeps the liquidity area. Okay. Number one, sweeps a crystal clear buy side liquidity or sell side liquidity. Equal highs, equal lows. After sweeping them, inside a sharp wick forms, okay? And price closes back inside the range. Now we have this sweep. This one is the sweep, okay? Then first candle closes back inside the range. Then after the sweep, not waiting for a break of structure. So you don't wait even for this break of structure right here. This one is the BS. You don't wait for it. You enter immediately. Then stop loss placement is just below the sweeps wick right here. Below there now. Your stop loss SL is sitting here. Once price has closed inside you enter on this rejection candle. Now this one is your entry. Not waiting for not waiting for a break of structure, okay? So to do something like this. Stop loss right here, then target the next. So tight stop loss, maximum RR. Typical leads for 1 to 5 to 1 to 10. RR, risk to reward. Okay? Here, discipline is very required. The entry requires patience to wait at your level. Okay? You do not chase, you wait. You do not move your entry zone. You wait or you miss it. So it's a quick one. It's the sniper entry. Ile unasikinga sniper entry. Best ones zinatokeanga once more. Liquidity sweep, rejection immediately. Remember in entry model 1, it was also almost the same as that, but we waited for a break of structure, okay? Sweep, break of structure, pull back, then you go with it. The next one is on, you wait for a gap to be filled, then rejection candle, entry, targeting that. The third one, that one is a sniper. You don't wait for a break of structure, okay? Because even you can find this scenario, price does not pulls back to continue. And if it pulls back, that one is the next confirmed entry. You're now playing entry model 1. But this one is now the sniper, entry model 3. The entry requires patience to wait at your level or you will miss it. What is the complete framework and complete risk management? Remember I said risk management is not just the stuff. Ooh. I said risk management is not just use of a stop loss. It's a comprehensive system of protecting capital and ensuring long-term survival in the market. So our standard risk management per trade is 1 is 0.5% to 1% per trade for beginners. Never exceed a 2% on any single trade regardless of the conviction you have. Okay? The daily max loss limit is at 3%. If you lose 3% in a single day, stop. Stop. Close the platform. The market will be there tomorrow. Your capital might not. In a week, if you eat a 5 to 6% drawdown in a week, reduce the position size by 50%. For the following week, this is recovery mode, not punishment. Okay? A correlation risk. Usually, you find that pairs like Euro USD and GBP USD are highly correlated. Trading both simultaneously effectively doubles your exposure. Be aware. So, what's the drawdown math? 10% loss requires an 11.1 to recover. A 20% loss, if you lose 20% of your account, you require 25% to come back to break even. If you lose 50%, you require 100% to come back to your break even. Position sizing formula. Your lot size, basically, the lot size that you're supposed to use is determinant of your account size. Let's say you're trading a $1,000 account. Mkulima mdogo, yeah? You want to risk 1%. So 1% is 0.01. Okay? So this one you divide by the stop loss. If your stop loss is 10 pips times your pip value. Pip value is determinant with your currency pair that you're trading. Now let's check you're trading Euro USD or GBP USD. Now for Euro USD or GBP USD, one standard lot size is equals to $10. Okay. Now your pip value here is 0.1. So meaning that $1 or one pip is equals to $10. Okay. Now let us do the maths right here. If we do the maths, this one will be like 10. I'm confusing something. Let me see. 0.1. Okay. Let me see. Where's my calculator? Okay, this one is 10. Actually, this one needs to be a 10 because I say that $1, if you're risking $1 is equals to $1 is equals to 10. Okay, one pip is equals to 10 lot size. For am I really saying the right thing? Okay, pip value. This is the value of a pip per. It's determinant on the currency pair that you're using. Now, if it is Euro USD, the pip value basically, okay, I'm going to do more research on this. Let me put it on a star, but this one is supposed to be 0.1. So you're supposed to use a 0.1 lot size. If you have $1,000 account and you're risking 1% on a 10 pips stop loss, okay? You're supposed to use a 0.1. So meaning this one is 10. So if this one is 10, that one means that your pip value is basically, if it is Euro USD, one pip on a standard lot size is equals to $10. So meaning that this one is a $10 pip value is $10. Actually, yeah, that's right. That's right. No need for any. That one is right. So 10. So this one is a $10 per pip. Okay, for Euro USD or GBP USD. But the best thing you can do, okay, just go and use my FX book calculator. My FX book calculator. If the math is not adding up, or maybe you're not trading Euro USD or GBP USD, maybe you're trading CAD JPY. Go and use my FX book calculator. My FX book calculator. It's a site. You just need to know your account size, the risk, stop loss. That's the only thing you need to know to fill out. Then it calculates on its own. Okay. So this one is automatic. This one even should not worry you. Now, risk management. If it is an order block, the most conservative conservative entry model, it has the highest probability of playing out. Typical risk is 1. Typical RR is between 1 to 2 to 1 to 4. It's beginner, best, and perfect for all conditions. Trigger or time frame break of structure within the order block. Fair value gap field, it's the moderate one. Highest kill zones mostly during London opens and session opens. Typical 1 to 3 to 1 to 5. Strong trending markets, rejection candles, or break of structure in the gap. Same as sniper entry. It's most aggressive. Highest, typical 1 to 5 to 1 to 10. High conviction of your setups. Fast close back inside the range. Sniper entries is where patience. The sniper entry is where patience pays. You wait at your designated position, then price walks into the range. You fire once with precision. No chasing, no second guessing. Now, session breakdown. Go and study 10 historical order block retest entries. Her time frame context, entry models, targets and outcome. Go and test these on the live market. Msisikie tu vitu nimewambia. Easy. Go and test it out. Or rewatch this video. Okay? Go and test it out on the market first before on the demo account before believing what I'm telling you. Look for fair value gaps, sniper models. Then this one I've told you to go to my Facebook. Position sizing drilling. You're going to use my Facebook. Then review your trades. Okay? Then demo execution week. Go and execute these models on a demo environment. Common mistakes: setting limit orders ahead of order block zones, anticipating for a reaction. Wait for price to arrive at your zone. Then look for a time frame confirmation, anticipating without confirming is gazing. Using a fixed lot size regardless of stop loss distance. This one is one of the mistakes that kills a lot of traders. A 50 pip stops and a 20 pip stops required a completely different lot size for the same 1% risk. Calculate every time. Moving break even before price has had room to develop often results in getting stopped out in eventual uh, eventually profitable, getting stopped out of eventual stop loss and profitable trades. Wait for a lower time frame break of structure in your direction. Before you move break even, wait for a break of structure to move. Wait for price to move significantly in your direction. A 1 to 3 RR trade will make me rich quickly. Risk to reward is only meaningful alongside the consistency and probability. Focus on the process, not the payoff. The money follows discipline. Okay? These are some of the assignments I'd like you to do. Study 10 historical order block retests. Examples for each, grade the setup and quality for 1 to 10. 20 position sizing calculation, use my Facebook. 5-day demo execution, take only smart liquidity trades. End of week review. Grade each each demo account in based on your quality. Okay. Identify your number one execution error of the week. So this is the end. This is the end of this. Go and do the assignments. If you can, send them to me in my DM. My DM is open in Telegram at Trader Mzambezi. Just go to Trader Mzambezi in Telegram. Send me to them. I'll review them. I'll be glad to reply to you. Take advantage of this time. So, peace out. Let's meet in the next class.